The tax-free savings account is arguably the best and most popular registered investment account to utilize in Canada, as it allows your investments to grow and compound tax-free, which can amount to massive tax savings over decades of investing. Now, I've delved into the intricacies of the tax-free savings account several times on this channel, with the latest update highlighting the newly announced $7,000 annual contribution limit for 2024, along with tailored strategies to leverage the TFSA based on your age and personal circumstances. So definitely bookmark that video for later viewing, but in parallel to understanding what the TFSA is and how it works, you should also be aware of some common mistakes that you'll want to avoid this year and moving forward for both beginners and more seasoned TFSA investors, which is what we'll be covering in today's video. Alright, so starting off with one of the most straightforward mistakes that new investors might fall into with their TFSA, this would be not fully understanding their cumulative contribution limit and therefore potentially over-contributing to their investment account, which leads to penalties and interest to be paid on the excess amount of the over-contribution. Quite simply, if at any point during the year you contribute beyond your available TFSA contribution room, you're obligated to pay a tax equivalent to 1% of the highest excess TFSA amount for each month the surplus remains in your TFSA. Here's a quick example. If you have a total contribution room of say $6,500, but you contribute $7,000 to the account, well, for each month where that excess $500 over contribution is in effect, you would be subject to pay a tax of $5. And I know this might not seem like a lot, but if you're negligent on the total contribution room and exceed it by a fair bit over several months, this penalty could definitely add up. So make sure to thoroughly check your MyCRA account to stay up to date with your remaining TFSA contribution room if you want to make sure that you're contributing the right amount. Now, in parallel to the last mistake, it's pretty common knowledge that each year the Canadian government sets a new contribution limit, for example, $7,000 for 2024, and this amount is then added to your total cumulative limit for all of the years where you're above 18 years old. For example, if you turned 18 in 2020, you would have a total cumulative contribution limit as of 2024 of $31,500. Pretty straightforward. But where things can get a bit complicated is when you make periodic contributions throughout the year and might also make some withdrawals. Well, these actions will impact your contribution room for the calendar year and what you're allowed to recontribute in the same calendar year. Here's an example. If you turned 18 in 2023, well, you would have a contribution room of $6,500 total. But if throughout the year you made contributions of say $5,000, only to then withdraw say $2,000 in the same calendar year, well, before the next calendar year ends up rolling around in January, you can only make another contribution of up to $1,500, not $3,500 like you might assume. If you were to recontribute that $3,500 thinking this would bring you back to your allowed contribution limit at $6,500, well, this would actually place you in a situation of over contribution by $2,000. So again, as you're making contributions and withdrawals throughout the year, if you want to be sure of your current available room, just check your MyCRA account for up-to-date details. Moving into our third common mistake that I've observed among many individuals, or at least a question that frequently arises, involves treating the TFSA more like a conventional savings account rather than recognizing its potential as an investment vehicle. Now, while this might seem evident to most, especially seasoned investors, it's crucial to emphasize that the name itself, tax-free savings account, could mislead beginners into viewing it solely as a tax-free savings instrument rather than a powerful investment tool for growth. This is especially true considering that some institutions offer a base interest rate on deposits in a TFSA, so I have seen some people get confused by this. Essentially, what needs to be recognized here though is that the TFSA allows for purchasing stocks, ETFs, bonds, mutual funds, and other investment vehicles within it, rather than just offering a return on cash deposits. And over the years, this mistake could very well lead to leaving thousands of dollars in tax-free growth on the table, as most savings interest options are far below the average annual growth rate of even say just the S&P 500. This leads me to mistake number 4 for the TFSA, which is failing to understand that you can actually permanently lose and gain additional contribution room depending on the success of your investments and when you choose to withdraw funds. So let's start with understanding how you can permanently lose contribution room. So as noted, you get an allotted contribution limit each calendar year. For 2024, it'll be $7,000. Now let's say that you'll turn 18 in 2024, meaning your total allowed contribution room will be $7,000, and you choose to invest the entire thing into a high-risk stock that unfortunately ends up losing 80% of its value throughout the year. Well, you only have a couple of options here. If you choose to sell that investment and then withdraw the $1,400 you have left because you want to, say, buy a used car, well, you'll only be able to recontribute $1,400 to your TFSA plus any future new yearly limits, because in the CRA's eyes, you've already made your $7,000 contribution for 2024. All right, so if you don't understand that technicality and you move forward with recontributing another $7,000 because you believe that you're able to do so in the same calendar year, well, you would be in a position of being at an over contribution of $5,600. Additionally, that $1,400 recontribution would only be allowed the next calendar year because you already made the maximum allowed contribution for the current year. I hope that makes sense. It's a bit complicated. If you do have any questions though, don't hesitate to ask them down below in the comments and I'll make sure to answer. Number 5 here, most people contribute to a TFSA with the goal of saving towards large purchases and retirement. Large purchases maybe being buying a house, renovations to the house, a car purchase, or any other large expense. Now, based on what we've just learned, if you're already fully maxed out and make a full contribution to your TFSA for the year in, say, February, but then choose to withdraw from your TFSA in June because you want to, let's say, buy a car, well, you need to understand that you won't be able to recontribute to your TFSA the amount of your withdrawal until the next calendar year rolls around. So if you know that you're going to be making a large purchase and you're able to plan things out accordingly, it can very well make sense to wait until the end of the calendar year to make that withdrawal, because as soon as January rolls around, you're able to recontribute the full amount and not miss out on the opportunity cost of not having capital invested and growing tax-free throughout the course of the year. In parallel to point number 4, I've seen a lot of new investors over the years invest in higher risk positions within their TFSA with the hopes of hitting it big and making a massive tax-free return rather than playing the long game with more stable ETFs, for example, that still have the potential of yielding massive tax-free returns over the years. And I say this because the reality is that most retail investors that manage their own stock portfolio are going to be consistently picking 10x stocks, even if that's what you're made to believe from an online day trader. That's just not the reality of things. And so although in theory your 10x gain would be entirely tax-free, that is true, it's often more advantageous for everyday retail investors to simply invest into broader market ETFs that still average 5 to 10% annual returns, which in the TFSA compound and grow tax-free over the years. But hey, if you're okay with the higher risk associated with picking individual growth stocks, the benefits could be massive. Just understand that TFSA contribution room can permanently be lost. Hey, quick shameless plug here. If you want to learn more about properly navigating the stock market with not only the TFSA, but also the RRSP and other Canadian investment accounts, make sure to sign up for my free stock market investing course over on Skillshare. There are over 1,500 students and 7.5 hours of curated content for you ready to watch. All right, back to the video here. A mistake that I see all too commonly is investing in a TFSA while you are carrying debt, especially high interest consumer debt. And in reality, this applies to investing of all kinds, not just in the TFSA. The reason why I bring this up is because I have had viewers in the past comment on some of my videos, well, hey, I am carrying some debt, but can I still invest in a TFSA because I'm going to be growing those funds tax-free anyways, so could this be beneficial? Right? And what's meant here is, say, paying 5% interest on a line of credit to then hopefully make 8% back on average with an S&P 500 ETF and pocketing that 3% spread. Now, here's my opinion on this matter. I use lines of credit all the time to invest in my real estate business at rates of anywhere from 5 to 12%. So I'm absolutely not against using debt to invest in a business when the goal is to make a return far higher than the interest paid, especially considering the fact that the interest is tax deductible since it is used with the purpose of investment. However, returns in the stock market are never guaranteed, and right now, most consumer debt and interest charged on lines of credit far exceed average market returns. So in a low interest rate environment, this could very well make sense, but especially right now when interest rates are higher, eliminating all forms of consumer debt before investing in a TFSA or other investment account is generally going to be the wiser decision. Moving into mistake number 6, that would be simply not contributing to your TFSA at all because you're waiting to time the market and start investing when you believe the markets will be more opportunistic. Now, here's the thing. If you have a decent salary that allows you to save even $500 a month, which happens to be $6,000 a year, nearly the total contribution room available for the TFSA yearly, and you don't have any high interest consumer debt, then you have no excuse not to invest in your TFSA. And you're leaving money on the table essentially. The reason for this is that anyone saving even a couple $100s a month should put that money into a TFSA before even, say, a high interest savings account, because interest in a high interest savings account is taxable. And right now, even if you don't want to invest in equities, for example, you can still invest within your TFSA into a high interest ETF that has little to no risk, yielding upwards of 5%. And that interest is tax-free in the TFSA. So it's really a win-win. To summarize, holding off with making TFSA contributions and even more so trying to time the market is generally going to be a futile effort when investing over the long term, which the TFSA is made for anyways, as consistent long-term investments often outperform attempts to predict short-term market movements. And anyways, you're not supposed to be day trading in the TFSA. More on that in this video. All right, now you may or may not know this, but any dividends earned within the TFSA from non-Canadian companies or ETFs, so any US stock, will be subject to what's known as the foreign withholding tax. If this is the first time you hear about this withholding tax, it's essentially a 15% tax on issued dividends that the IRS withholds at the source. So you never have to worry about this as an investor paying that tax yourself. It's done on your behalf, but I have seen many people online and in forums give this way too much thought, in my opinion, which I've seen lead them to avoid investing in US equities altogether, which I believe to be a massive mistake. This is because, historically speaking, US equities outperform Canadian equities on an average yearly basis. So avoiding to invest in them altogether to avoid a 15% tax on the dividends alone simply makes zero sense, especially when considering that the position itself and leftover 85% dividend continue to grow tax-free within the TFSA. What's a lot more important and worth your mental energy is focusing on picking quality ETFs and positions that have a history of positive company and stock value growth over the long term. And finally, consistently reevaluating and readjusting your investments within your TFSA is a fundamental practice that directly influences the alignment of your portfolio with your personal financial objectives, which is essential for optimizing the performance of your TFSA long term. The thing is, I totally get it. It's exciting to set up your TFSA for the first time, but your investment portfolio is like a plant that needs consistent watering to perform. So neglecting failing to engage in periodic assessment and rebalancing can result in an uneven distribution of assets within your portfolio, where over time, market fluctuations and varying rates of return on different investments within the portfolio can cause your initial and sought after asset allocation to deviate from your intended initial strategy. I hope today's video is going to help you avoid those top 10 TFSA investing mistakes. Once again, if you enjoyed the video, make sure to drop a like, really helps the channel out. Don't forget to check out my full stock market investing course for free over on Skillshare. And if you're new to investing, need to open up a TFSA, RRSP, or other investment account, check out the links down below in this video's description. There are multiple different accounts that you can open from different brokerages, and you'll get free money for signing up to each and every one of them. Thanks a lot for watching. I'll see you in the next one.